The following was recorded in front of a live studio audience at the Studio 21 Podcast Café. This is the United Podcast Network.
Welcome to the Stock Market Authority Podcast. I'm Bakes, Kevin Baker. I'm going to teach you how to make money in up and down markets. Very few podcasters or coaches cover this. I'll show you how to lock in profits and minimize losses to make you a better investor. So once a week, you're going to know what's going on in the world and the stock market. Welcome to the Stock Market Authority Podcast. Hey, this is Bakes, Kevin Baker, Stock Market Authority. Happy Wednesday to you. Hope you're having a great week, and welcome to November. Holy cow. This is unbelievable how fast the year's going, and I think the guitar work in that was really, really good. I don't know who played that, but just a really great start. Bottom line is I did it because I couldn't find anything that I liked, so I recorded my own. Anyway, today we're going to talk about, this is what's in it for you. The Magnificent Seven is now the Modest Five, and we're seeing the big generals in the stock market roll over, and I've been walking through that this week. I'm going to do it more here. Number two, we're going to open the mailbag. Chipotle, which everybody knows. Veronis, which I didn't know. VRNS is the symbol. And we're going to talk about General Motors, the strike, and a lot of other stuff. And we're going to go through the portfolio. And this is my search as I go through 3,300 plus charts. Every ETF that's out there, I try to find the 10 best so that we make money. Humble brag, we made money last year when everybody else was down, and we're working our tail. I'm working my tail off to do it again. But right now, today's top story. NVIDIA's looking like Cisco 2000, and I've been saying that it did not look like that yet prior, and now that's changed. And what I've been doing this whole week is going through the Magnificent Seven: Tesla, Apple, Google, Amazon, Microsoft, Meta, NVIDIA. I've been doing that in the newsletter, and now I'm coming here. I've talked about the prior four. I'm going to talk about three more right here. But the bottom line is that's 28% of the market, and the pundits have been saying, oh, my heavens, this has been a very concentrated market. And I didn't care until the charts told me that it was a problem, and now it's a problem. Okay, so I talked earlier in the week about Tesla. That's become a sell, at least 1/3. I can go into that a little bit more if you'd like. Apple also looks bad. They report tomorrow. We're going to learn a heck of a lot about what's baked into the market, and Apple in particular. Then I talked about Google and Amazon, and right now I'm going to talk about the last three. And this is in descending order. So this is basically I came up with the Magnificent Seven becomes the Modest Five because they're taking on water, and the earnings reports are being greeted either with yawns or with Bronx cheers. And when things change, I'm going to tell you things are changing. And I'm not going to be dogmatic and say I'm right, the market's wrong. I'm going to go with the market and sort of, perform jujitsu as best I can. Okay, Microsoft. This is the third cleanest dirty shirt. I hope I have a Johnny Cash fan out there someplace. But anyway, it's a great line from Sunday morning coming down. Microsoft looks okay. It held this 310 level. It hasn't come down to the 200-day moving average. It's expensive, but it's Microsoft, so it ought to be. It's the number 2 or 3 name in the S&P, depending on the day. Trades at 30-plus times, grows at 15. If it wasn't Microsoft, I'd say, the heck with this, who needs it? Earnings report was pretty good. People liked their cloud business. And obviously they have the open AI component to their story that people find some solace in. So now the earnings report was good. It bounced. But it wasn't that impressive, to be honest with you. Yep, the volume picked up. I like it. So this is the fifth out of the seventh Magnificent Seven. It looks okay, but that's all it does. It looks okay, and to me, it would be a hold, an unenthusiastic hold, but a hold. number 6 is Meta, M-E-T-A, the artist formerly known as Facebook. And what they basically did was stop spending a lot of money on the metaverse, cut back expenses, and earnings have rallied. The base business, especially Instagram and Reels, is acting pretty well. The earnings report was okay, but the stock sold off. And my whole thing is, if earnings don't make stocks go up, what's going to? And in the case of Meta, I think it's another sign that the market is saying, yes, all these stocks got crushed last year. They probably were overly punished, and we're going to let them bounce in the first half of the year. Now here it is in November, and we're staring at 5% interest rates. And these long duration assets, longer term growth stories are becoming less valuable because the competition for interest rates is pretty substantial. So Meta to me is a hold. Again, if I was going through the chart book, I wouldn't be jumping up and down on this. But it's just a sign that the top 28% of the S&P is getting heavy, and it's weighing on the rest of the market, which brings me to NVIDIA. The pundits have been talking about, this is reminding me of Cisco 2000 and the internet bubble. And I said, not yet. Now I'm saying it's getting closer. I mean, if I take a look at this, it looks like it's forming a head and shoulders pattern, and I'm sorry if you're walking the dog and working out and getting this, but it's a classic technical pattern, which you can understand looking at a left shoulder. The stock hits a new high, the head, and then it rolls over on the right shoulder. And we're starting to see that happen, and the down days are starting to show increased volume, and I don't like that. So it spent a lot of yesterday under 400, and I wanted to see that 400 to 500 stair step being built. And this is the last company to report. Apple's tomorrow, and then this is the last one in 3 weeks, and we're going to learn a lot. They have obliterated earnings the last couple of times, and I think expectations are pretty lofty. People say, well, this looks expensive. It's on 2025, the consensus number, which I probably think is light. It trades at 26 times. It grows 60%. So, yes, it's had a big move, but the demand for their chips has been monstrous. And they could sell every single chip they made, and their capacity constrained. So this is the cleanest dirty shirt in the laundry, and it looks like it wants to roll over. It hasn't yet. I want to be really clear. So that, to me, this is a hold, probably my most enthusiastic hold. Again, if I was going through the chart book, I wouldn't buy this. If I had been there from 300, I'd say I'm watching this. Now, the 200-day moving average is at 350. And that sounds like that's obviously 50 points away from where we are. This is not a perfect world that we live in. If it takes that out, then it becomes more Cisco 2000-like, and I get more concerned. So now I'm going to go to this my last chart, and this is from my library. And this is where I hope I add some value. I've been doing this forever. I was there in 2000. I've got this yellowed, heavily dog-eared book back here, and I put this chart in there. This is what a stock looks like when it's rolling over. And you can see here, you've got the head and shoulders at the top, around 85 or so. By the way, the year before, it went from 15 to 85 in 1999. So, I mean, these things can have massive, massive moves, which is why I don't say, well, there's no reason. NVIDIA's market cap has gone up by, X hundreds of billions of dollars. The market cap is set by the market. It just is what it is. And people that, think that, their knowledge of the market cap or what it should be is the right one, I think is ridiculous, myself personally. So you take a look at this, and I'll put these together perhaps for the newsletter. But things really started to go north on their first quarter call when they said, you know what, we're over our skis here. I'm paraphrasing. This isn't what they said. Demand's not going to be what we thought. And then it closes below the 200-day and then really rolls over. And so the sell discipline that I deploy got you out around 65 or so, and it went down to 12 in about a year and a half. Now, I'm not saying that's what's going to happen in NVIDIA, but what I am trying to impress upon you is that I have a historical context that I want to bring to you so that if I see this happen with NVIDIA or any of your stocks, which are the ones you care about, I can point out and say, this is a problem. And this is what has happened in the past, especially if you work for a company and it's a big part of your compensation and part of your wealth. I don't want to have a Silicon Valley bank happen to you that that really creates a lot of damage for you. So NVIDIA is not Cisco 2000 yet, but it's looking a lot more like that than it did when I talked 6 months ago. So I just want to have you hear my change in tone, get a sense that I'm willing to let the market tell me what to do, and not become strident and dogmatic and say, I'm right, the market's wrong. That's a very painful and expensive sentence to utter, in my opinion. So the Magnificent Seven is now the Modest Five. Even the strongest NVIDIA is starting to take on some weight, put on some weight, and because of the size of these companies, it's weighing on the entire market. The S&P 500, which we talked about last week, where I very subtly said sell stocks now. Now I'm telling you, okay, here's the components, the main drivers of the components, and here's what I see, and here's my rationale, and I hope it's helpful. Do me a favor, please. Go to my website, stockmarketauthority.com. Sign up for my free newsletter so you can get these things that I talk about in between the official podcast here, and you can see my thinking intra-week, so that you're kept abreast of what's going on. And go to Bakes at stockmarketauthority.com, my email, or at BakesTakes_ and fire away. I just had a couple, while I was driving up here, and I love this stuff. I love coaching people, and fire away. So that's today's top story. Now it's time to check the mailbag.
Incoming! There's a letter in your mailbox.
You got mail.
And my wonderful son came in with a couple, so I want to see what he has to say. Please. Thanks, Chris.
Hey, Dad. Happy Halloween. I have two quick questions for you, if you don't mind. First, on Chipotle. One of the few restaurants we're seeing with positive and accelerating traffic per their most recent quarterly earnings. Could you ever give me your analysis of Chipotle CMG as a buy, sell, hold?
Thanks for reminding me to use one of the. By the way, I love you too. And the Chipotle is a hold. Now, having said that, it would be a hold of the 2/3 that I would still have. When I put this red arrow here pointing down. That's when it closed below the 200-day moving average, I would sell a third. I don't own this right now, full disclosure, but you know my discipline. It closes below the 200-day. You've had this big move up, sell a third, and then, yes, there are some times when things reverse and they rip to the upside. It doesn't happen too often, frankly, but I don't want to just I don't want to go all or nothing. I want to have a gradual approach to getting out of big winners. And so here, I would have sold a third and hold on to the rest and watch it like a hawk. The 200-day moving average is at around 1,200, it looks like here. And I would watch that very, very carefully. A couple things. It's always been expensive. It's expensive right now. Trades at 40 plus times. Growth is around 20-ish. Okay. I think part of it was the expectations were pretty low going into this report, and then they made some positive comments about traffic, as you said, and they're doing this grand experiment. How much can you charge for a burrito when people still show up? And can you raise prices so that you maintain margins? And so far, it looks like they're doing that. But I think it's mainly you had a gap down on the last quarterly earnings report, and that was about 196. 196 now, sorry. Yeah, just under 2,000 or so. I got my numbers wrong. But this resistance here at just under 2,000, it kind of that's where the stock is right now. This is where you're going to stall out, in my opinion. So I think the chances of it closing this gap are pretty low. If earnings reports don't move stocks, what the heck will? And so this is a kind of thing where I think Peter Lynch was wrong. I said that last week about a couple other stocks. Yes, it's familiar. Everybody knows it. I don't think you're going to make a lot of money here. So I think, good for you if you owned it, at 1,000, and here we are at 1942. It, to me, suggests it's going to have a hard time breaking out above this resistance line that I've drawn and close that gap. And now the volume picked up. That's what I want to see. I think that's more of a dynamic of dampened expectations and then a relief rally that's happened here. And I would hold on to the 2/3, and I would watch for my self-discipline to kick in. And I hope I've answered that, and I hope that it's helpful. Let's go to the next one, please.
Also, Veronis Systems, ticker VRNS. They design and develop data security software solutions. And there's some strong technicals that I heard on a call the other day and was hoping you could opine on. Thanks and love you.
Love you too, buddy. I am blessed beyond words, my boys. And just for new people on YouTube or on the podcast, this is the whole reason I did this. My sons were at business school. They worked in the student-managed investment funds. They would fire questions at me. Their friends would come in, and it's a shameless excuse for me to talk to my boys more than I otherwise would. And their friends come in and text me and email me all the time, and I love this stuff. I really do. So I just give my thoughts on what I tell my boys. And then you can do with that information what you want. This isn't financial advice. You're smart people. I don't know your situation, but I do know something about this. Anyway, Veronis, VRNS, had not seen this company before. Anything data security is a pretty good business right now. This to me is a buy, Jack. And frankly, I put two arrows here. It was a buy at 28 or so, a buy at 33. It's doing exactly what I want. It's coming off pretty meaningful lows, and it's attracting new institutional interest. I can see it here in the chart. The earnings reports are being greeted warmly. The volume picks up on the up days, and it's a pretty chart. It's a pretty chart, and it's a pretty chart with a lot of other data security software names are acting pretty badly. See Okta, if you will. So I think you've got something here. I agree with the technicals. I have not done any fundamental work, full disclosure for you and for everybody. But this is what I want to see. I want to see a staircase being built. And we're just starting to build the next stair step. And it is not too late for this one, in my opinion. And when you have stocks gapping up on earnings reports, that's a good sign. Gapping up on big volume is even a better sign. So Veronis to me is a buy, and I think you have a winner there, and I can't wait to see you. All right? Love you, pal. Lastly, Mary from Michigan came in, said, I'm a Share Scoop subscriber. General Motors just joined the other automakers in settling their strike with the UAW. What do you think of the stock? And I say, I'd rather pull teeth than own this stock. It is a sell, period. I know it's cheap. It ought to be cheap. The company is shrinking. They just signed up to have increased costs for the next 3 years, and the workers probably deserved it after what they did during the great financial crisis, and to claw back that, make up some money that inflation is eating away. I understand all that, and I understand that the profitable truck business is a good place to be, so getting those plants up and going is a positive. The problem is, I think that they confirmed this week that Elon Musk goaded them to get into the briar patch that is EVs, and they wish they hadn't. Now, they won't say it like that, but I'll say it like that. The EV business is a bad business. And I know I'm going to catch some flack from share scoops and other people, but I call them like I see them. Tesla themselves said, and they're all EV all the time, and they basically said, our price increases aren't increasing demand, and higher interest rates are hurting the consumer. The economy is weakening, and our EV sales are suffering. The earnings report was really, really downbeat, and the chart shows it. Hence the sell that I mentioned at the start of the program. So Ford said negative things about EV as well. Toyota, the EV business. I understand the grand, save the planet and decarbonization, but there's nothing noble about losing money in your efforts to improve climate change. So to me, uranium is going to beat EVs dramatically over the next 2-3 years, and I think this level here at 32 or so, that's been in place for over a year. The stock's at 28 right now. I think that's the lid, and I think it's going to be a substantial lid. Of all the gin joints in all the world, I'm not going to walk into this one. So General Motors, sell, goodbye, don't look at it. I think 32 is your lid, and it's to hold around for 3 points, I think, is kind of silly. Sorry to be so blunt, but that's what I see. That's it for the mailbag this week. If you want to write into the show with any questions or comments, email me at bakes@stockmarketauthority.com, and even better, send your voice memo to that email, and we can play your question on the show like we did for Jack. Let's take a break. When I come back, we'll take a look at the Stock Market Authority portfolio. I'll give you this week's Bakes Takes. You're listening to Stock Market Authority. Hang in there. We'll be right back.
Do you want to become a better investor? Do you want to learn how to make money in both up and down markets? Then you need to go to stockmarketauthority.com and sign up for our free newsletter today. Stock Market Authority is run by award-winning investment manager Kevin Bakes Baker. His aim is to save you time while teaching you how to be a better investor. Bakes saves you time by diving into all the latest stock market news and information so that you don't have to. He reads all the latest articles, analyzes the charts, and listens to all the relevant podcasts. And then once a week, he gives you a breakdown of what's happening in the market. Stock Market Authority is constantly outperforming the S&P and the HFRX. Bakes is going to share with you his weekly stock observations. He'll give you concise insights and show you how to lock in profits and minimize losses. Stock Market Authority is making money in up and down markets. Wouldn't you like to do the same? So join now and let Bakes show you how. Head on over to stockmarketauthority.com and sign up for our free newsletter today. That's stockmarketauthority.com, making money in up and down markets.
We are back, and today we're talking about NVIDIA looking like Cisco 2000 and getting heavy. And I just call them like I see them, folks. But now it's time for the Stock Market Authority portfolio. And I draw your attention to this. The main thing I want to point out is no big losses. And be honest with yourself. Take a look at your portfolio, either literally or in your mind's eye, and how many 15% plus losers do you have? I don't let it happen. My biggest loss is 4.8%, and it's one of my smallest positions because I just refuse to lose a lot of money. I've seen this movie. I've made these mistakes, and I know what it's like when you spend 80% of your time trying to hope your way into the 20% of your losers that are dragging down the portfolio. You're an individual investor. You can do whatever the heck you want, and the institutions can't, by the way. What I try to do is I'm doing it tonight. At the end of every month, I go through 3,000 plus charts, and I try to find the 10 best. And I don't care where they are, what they do, and we just have the ETF industry has given us incredible flexibility so that we can do this, and it's worked. Since inception, we started this in the middle of COVID. We've beaten the hedge funds by two times the hedge funds. We have the ability to go short, so I compare myself to the hedge funds. This year, we're not doing great. We're down 12%. The market's up 9%, and I'm still throwing punches around and preaching from my chair. Thank you, Pete Townsend. My goal is to make money every year, and this came from several conversations I had with folks who pull me aside and say, "Bakes, I just got an inheritance, but I'm terrified of losing money. I retired, whatever." So I think there's a place for an all-weather fund for the everyman to buttress what goes on with the S&P 500, which is up 70% of the time, but the down 30% of the time can hurt and scare the hell out of people. So that's what I'm doing. So far, so good. My end game is, and I talked about with my good friend Roger yesterday from the University of Houston, is, and I'd love your feedback on this. I'd love to provide coaching, perhaps individually, especially if you're in a student-managed investment fund program where they'll teach the textbooks and I'll teach the School of Hard Knocks. I know how to sell. I know how to read charts. I know how Wall Street works, and I might do something like that. I might offer a course and tell me, what you'd like to from that. I'm going to likely launch a premium Substack, and down the road, I'd like to have an ETF that serves as your hedge fund and replicates what I do here. So stay tuned for all the above, and I'd love your feedback, and I certainly want your support. Right now, we're 25% uranium, and this is really playing out nicely. Cameco, the number one name in the space, blew out earnings yesterday. Both our ETFs, the Sprott uranium miners and the junior miners, URNM and URNJ, are acting great. They were acting great when I was driving up here, and we just took out 74 spot on the uranium price itself, and I think it's going to double, and I think the stocks go up more than that, and I don't say that very often at all, if you've been paying attention. We're 7% oil and gas services, and I'm still struck by, especially listening to all the Economist podcasts and what's going on with Gaza and neighboring and interested countries. I don't see how oil doesn't go up. It just doesn't make any sense given the conflicts that surround the oil-rich parts of the world. We're down in technology. We took it down. We're down to 5%. Biggest name in this is NVIDIA, and it just I eat home cooking. When my self-discipline tells me to get out and reduce positions, I do so, just like I mentioned with the Magnificent Seven. And the Magnificent Seven are rolling over, and that's almost all tech. So we took our tech down accordingly. You've seen that over the course of the week in my posts, if you've been paying attention. We're 13% in Bitcoin. That is really acting well. We're 7% in Ethereum. My personal thought is the market is starting to sniff out the dysfunction in Washington and the explosion in debt and the squandering of money that is crowding out and eventually will lead to a devalued dollar. And people are at least putting on a partial hedge against that in crypto. where they can't print crypto the way they can print dollars. And I think that's what's playing itself out. Egypt is 10% of what we do. We're 7% short real estate, 4% short the Russell 2000, 1% short we're long Pakistan, and 19% cash. And I know that is an eclectic and unusual portfolio, and you're welcome. And stay here tuned. I will go wherever the charts told me to go, and we'll make money in up and down markets. That's what we're doing and have been doing, and I'll continue. I'll go through recent improvements in my newsletter and my social media posts. Please subscribe, follow, and share. That's how we're invested November 1st with 2 months to go. Let's get into this week's Bakes Takes. And my takes today are brief. Number one, if you're a student-managed investment fund, I'd love to hear from you, and we'll talk about courses and coaching and all these good things, how to sell, how to read charts, how Wall Street really works, and I really want to add value. And the feedback preliminarily is very positive. My next point here is I'm reprising my podcast from, I think, 3-4 weeks ago, where I said, interest rates are higher for longer, get used to it. And this comes, and I'm reprinting the same chart because it's a 40-year chart. And what it shows is, this is the 10-year government bond. It was 15% in 1980. It went down to zero virtually, and here we are at 5. And the reason I bring this up is that from talking to you and listening to a lot of podcasts, I hear this, well, when rates come back down to normal, then the stock market is going to act better, or the Fed's going to lower rates, and that's going to help the stock market. And I wanted to just put it into context. This is a reversal of trend that's been in place for 40 years, and I don't think it's going to end anytime soon. So I know most of you have only seen really low and falling interest rates. And my point being, especially as you look at this chart, 5% 10-year is still below normal, and 7-8, if you had to average all this chart out, that's kind of what you'd like. So I want to dissuade you to think that I'm waiting around to see when the interest rates come back down to normal. I think we're going up to the normal that's been in place for 40 years, and I want you ready for it, and I don't want you to be. Hope is a 4-letter word in investing, and I hear too much of, well, the Fed's going to cut rates, and and they're going to bail us out again. I think that's over. I think that the rates are going up, and I don't think they're going back to the peak. But I think I don't think it's higher for longer. I think it's higher sooner. Is the thought process that you have to be aware of, and that's why the big 7 are weakening as much as they are. They're sniffing this out, in my opinion. So I don't think this is going to stop anytime soon. Get ready for higher rates and sooner. And my next one is kind of what I think is driving this to a large extent. No one cares about the debt or deficit until the bond market and the bond vigilantes tell them to. Well, they're speaking pretty loudly. The interest rate, the average interest rate on all the federal government debt, $25 trillion plus, has gone from 1.5 to 3 in a year and a half, and it's doing nothing but going up from here. And the government needs to borrow more money with every single month. So this is, and a lot of this is in sacred cows. Social Security, defense, which shouldn't be a sacred cow. You get the idea. So this is real cash that's going out the door to bondholders, and it's crowding out other things. And the market participants are saying, I need a higher interest rate to be compensated for the risk of lending you money for 10 years. So just kind of get ready for this, and don't be thinking that we're one Fed meeting away from relief. I don't think that's happening. So anyway, please go to my website, stockmarketauthority.com, sign up for my free newsletter. Those are my bakes takes for the week. As we close out today's show, I always like to end with some much-needed levity. And please click on the description link in the description below. This is Gary Gulman, favorite of mine. Saw him at the Comedy Cellar, which I really recommend, and I recommend him very much. This is 5-6 minutes, and it's his funny bit on how the states got their abbreviations. Mom and Dad, it's clean. And that's it for today's show. I don't know what the heck I'm going to be talking about next week. I want you to tell me and ask me, and I will have a lot of fun. I will see you next week. Keep smiling. God bless you. Bye now.
The views and opinions expressed by the hosts, guests, or callers of this program do not necessarily reflect the opinions of the Studio 21 Podcast Café, the United Podcast Network, its partners, or affiliates.